Hi, and welcome back to the Pie Podcast. I am your host, Irene. As usual, share, like, subscribe. You know the drill. I'm going to walk away from that so you guys can do what you need to do. Last week, we spoke about investing in asset backed securities, investing in different financing options, whether it was student debt, mortgages, car finance, and so on and so forth. Now, I want to make sure that we have a rounded view in terms of how you can invest in real estate apart from the traditional way where you purchase your property and you live in it. So, we're going to cover real estate investment trusts today, and that's essentially going to focus on the asset side as opposed to asset backed securities, where we talked about financing mortgages, which was then giving a particular focus on the financing side of this style of investment. I'll just quickly begin by giving you the differences between the real estate investment trusts and the asset backed securities, just so there's no confusion between the two because they're doing completely different things. When we talked about the asset backed securities, in particular mortgages, we said that you're going to invest in the financing of the mortgages, right? And we talked about a special purpose vehicle which is built for investors to select the type of security that they would like based on the risk profile and facilitate individuals owning mortgages through that structure. Now, the investors are then going to get income based on the principal and interest repayments that the borrower is essentially making on the finances they borrowed from the fund, which the investors ended up issuing to the bank. So, with asset backed securities, that's particularly focusing on getting income and principal in some cases, because as well, you could be a buy to let investor or you could be a mortgage homeowner who only pays back the interest element of your financing. And for that reason, the investor can either get back principal or interest. So if you want to invest in real estate investment trusts, you are going to purchase a unit of a property. I'm referencing things such as offices, I'm talking about warehouses, your retail establishments, say your shopping malls. I'm talking about, your doctor's surgery. There's a whole list of commercial property that you could actually own through these means. And so you essentially get a fraction of a unit. Now, the fraction of the unit depends on how many investors are invested in that fund and how many shares have been issued for the public to purchase. So these assets tend to be acquired through, again, we talked about investing through the stock market. And when we covered this for first time investors, we talked about investing through index funds. And you can actually get a real estate ETF, which will essentially give you exposure to that particular asset class. And so, depending on what you purchase, that's going to afford you a unit of a property or a unit of the asset that is being issued for sale, I would say. Now, that is essentially the difference between the two, where with one, you're actually financing, with the other, you're actually owning the asset. And when it comes to the real estate side of it, the real estate investment trust, you will actually get your income back in the form of dividends. So, say for example, the way you get your dividends from a company on the regular stock market, say perhaps they've received some income from the activities that they're undertaking, they will then proceed to distribute the income they have to the investors. Now, the good thing about the UK is that the majority of that income is actually distributed back to the shareholders, and this tends to be in the area of 90%. However, there's allowances made for your tax purposes. And so, depending on your individual circumstance, on average, 90% of the income is distributed back to the shareholders in the form of dividends. So, if you want to get back your money from a real estate investment trust, you're going to go ahead and proceed to initiate a sale on the stock market. So that's the only way you can get your money back, either through selling, and the other way is through receiving your dividend income. So your dividend, again, you could always choose to reinvest that as somebody who's looking to grow wealth, or you could choose to have that sent to you and you can utilize it in any other way that you would like to. However, for the purposes of building generational wealth, which is a topic that we absolutely adore in this podcast, you perhaps want to consider the benefits of reinvesting that money. Whereas if you're looking at the asset-backed security mortgages, you're getting your income from the financing repayments that the borrower is making. So I hope you have that distinction clear between the two, and I can then proceed to cover the REITs in a bit more detail. I'm going to say why I love this investment class in particular. I think it's a very clever way to invest in real estate, right? Because we're used to traditional methods, perhaps, where you purchase a property. What do you need for that? You need to have your credit history checked. You need to ensure you have a deposit to be able to substitute the financing that you're going to get from whichever financial institution is lending you the money or proposing to lend you the money. You then have to work on the maintenance aspects of owning the property. If you're somebody who perhaps is a landlord or wants to get into buy to let as well, you need a 25% deposit on average to be able to own a property. So the capital outlay for those types of investments is actually quite high. And with real estate investment trust, I'm just going to call them REITs in short, because that's the acronym that is widely known across the industry. With the REITs in particular, you can put in £100 and you can get a couple of units or perhaps a fraction of a unit in a property. And the good thing about it is that if you decide, you know what, I don't like this asset class, you could just go and initiate a sale, and that's how quickly you can get your money back. So you may remember we spoke about liquidity. In case you missed the conversation around liquidity, you can go back and reference that video, and that will help you shed some light into what we're talking about. But in terms of liquidity, we said that liquidity is the ability to turn whatever asset it is that you have into cash fairly quickly. And for that reason, with REITs, the fact that you can trade it on the stock market means that actually it's fairly quick to get your money back from that investment or pull your money out of that investment, should I say. Whereas if you're looking at investing in real estate in a physical property on your own, be a landlord, be a homeowner, the process of buying a property is actually quite intense, or selling a property is also quite intense. You might be listed on the market for, 3, 4, 5, 6 weeks, who knows, it might go on for months or even a year before you can actually get a buyer. Now, we know once that's happened, you then have to go through the process of the legality of that transaction. You've got to answer all these questions. The property has to be surveyed, has to be valued, and there's a whole list, like a whole laundry list of things that need to be done before that transaction can actually be completed. And so that affects the liquidity of that asset, meaning that you cannot turn it into cash as quickly as you would like if you're comparing that to real estate investment trusts. Now, I'm going to put a caveat here, because we also do have real estate investment trusts that are traded in a, perhaps, will I say, a separate section of the stock market. This is like a section that allows companies to actually be listed before they hit the main stock market. The regulations are actually a lot less stringent, and it's a way that allows smaller and up and coming companies to be able to list on a market and be able to get financing from it. And the AIM section is essentially the alternative investment market in full. And so that's a secondary market which can be a little bit less liquid. However, you do get more frequent transactions than you would otherwise get if you're investing in a sole property as a sole owner, and so on and so forth. So I hope that clarifies for you that you do have a secondary market called the alternative investment market, which is AIM, and the levels of liquidity between that and the FTSE 100 vary. However, we are saying that the level of liquidity in the REITs in general, whether they're listed on the AIM or the FTSE 100, means that there is a better level of liquidity compared to the traditional property investing. Now, personally, for myself as an investor, the management side of it, right? Whether you have a tenant living in the property, whether you've got to do your repairs and your maintenance, that's completely removed from the equation, because if you're investing in a REIT, the company actually has a management arm which takes care of all those transactions for you. We don't need to talk about the tax benefits because we've already talked about investing through the ISA. Now, we know owning second properties in the UK can be an absolute nightmare when it comes to the tax aspect of it. And so, with your REITs, you're not being looked at as a second home owner. You're therefore going to not face the stamp duty that comes along with being a second homeowner. So it's a very good asset class to invest in for people who want to get into real estate and just think about the affordability side of it. If you did have small amounts of capital that you're willing to put in on a regular basis, then you could still get your share of the real estate investment market. The landlords of these properties tend to sign very long leases as well. So think about being a residential landlord who perhaps has a contract with a customer that covers a 6 month period where or a 12-month period. When you're looking at the real estate section, contracts are as long as 10 years, 20 years, and upwards. And so that gives you a lot more security in terms of receiving that consistent cash flow. So, depending on your particular interest as an individual, you can direct your investment to a particular asset class that you like, whether it's retail, whether it's offices, whether it's healthcare sectors. It's for you to decide where you want to invest in, or you could decide to invest in a variety of them and have your portfolio diversified. Now, unless you're somebody who's got significant amounts of cash, it's very difficult for you to then go and outright purchase a building. And because the income on these assets is fairly regular, it's fairly consistent because we know these are mostly businesses operating within these spaces. It doesn't mean that there might be challenges with the rental payment. It just means the long-term leases, the fact that somebody else is doing all the hard work for you, all you have to do is put your money there, then I would say it's a very clever way to get involved in an industry that you don't really know a lot about. And once you've got yourself into a position where you have the cash or the knowledge that you've gained is significant enough, then you could choose to perhaps redirect and do something on a more individual basis if that's something that you are keen to do later on down the line. So the last thing that I want to cover is the risks involved with this type of investment because we're always going to give you like a neutral view. I'm not trying to direct your investment intentions one way or the other. It's to give you the information so you can then go ahead and make decisions based on what is suitable for your particular situation, based on your risk profile, for your investment style, and so on and so forth. Now, when we spoke about the ABS securities, we essentially said that the way the ABS securities work is that you're going to put your finances in a particular pool, and that will then be distributed to the financing institutions who issue out the mortgages. And we said that the risks surrounding this type of investment, the income in this type of investment, would be largely to do with the economic climate. And we covered COVID in particular because COVID was one situation that clearly showed the challenges that can arise when people are not employed and therefore they're not able to make their payment on their mortgages. It's the same thing with the real estate investment trust. If you're renting these buildings out to offices and you have economic conditions that prove to be fairly hostile and the companies are not able to pay back their rent as promised, and particularly if you think about retail, I think the retail industry has been challenged for quite some time now. You've got so many of them going into administration. And for that reason, it means that your income is at risk. The property still remains there. You just have to find another tenant to take over that lease. And there might be fluctuations in income as a result of that. Demand may also fluctuate depending on what's happening in the industry. So, for example, if you think about the move to online retail in many places, it just means that the use of, I guess, retail spaces, if you're thinking about shopping malls in particular, the use of those shopping malls would now need to be reconsidered and perhaps redesigned to be able to facilitate a different type of business. So we're saying invest for the long term because that gives you a better chance at getting a good return on your investment. I hope this has given you some insight into the real estate investment class as an asset class. And for people who are considering getting into this type of investment, whether you're thinking about owning property and renting it out, it's also good to have the information on different ways that you can invest in the same type of asset with less hassle and get the most of your money. So I hope that's been useful for you guys, and thank you so much for joining. I will see you next time. Bye for now.